Welcome to BAM It with John Michael and Mari, covering all things business, accounting, marketing, management, and IT. The place where businesses and entrepreneurs find the forest through the trees.
Welcome to BAM It, and today, of course, we have the usual John Michael Kledis with Peridot Consulting and Mari Peterson with Marketing Outpost. Today's episode is going to be just the two of us, back to the two of us and no guest. We will be talking about creative tax strategies and opportunities. So this is a fun topic because we've actually had some tongue twisters around this title. We wanted to call it obscure. We don't want to call it a couple of other things, but I think it'll be interesting because it is a little bit about how do people reduce their taxes. Is that right? Am I saying that right?
Sure.
Okay, in some ways that maybe you're not aware about. So we'll get into that later. But first of all, let's talk about interesting facts. John Michael, do you have any interesting facts about taxes?
Well, I thought you were presenting all my facts about taxes are interesting, Mari. But I guess we can kind of lead into our topic that there is just a lot of tax stuff out there that people don't know about. You know, back in I think it was 1913, the federal tax code was only about 400 pages long. And today it's over 70,000 pages long. So I always, I hear that a lot. People say, oh, the tax code is so big. But 90% of that is on how not to pay taxes or things you don't have. It's also including things you don't owe taxes on, because they have to put that in the tax code too, not just what you're being taxed on, or different ways, or there's scenarios, and they have to cover all that. So yeah, it's more complicated, and it's kind of often referenced as like a ridiculous, look how complicated it is. It is. I'm not saying it's not.
Well, I think too, it's gotten so much longer because the time between 1913 and today, we have had a lot more politicians that like to create regulations.
Yeah, it's a way politicians can.
And number two, our commerce has changed and the way people make money has changed. And so there's all these nuances, and just seems like every time there's, back then we didn't have the internet. And aren't there now all kinds of taxes just based around what you buy and sell online?
Well, sales taxes, sure.
Yeah. So I just think that that's giving you more work. The more pages, the more work you can have, right?
Yeah. I mean, I guess I'll say that. But it also, like, the more simple it is, the more opportunity for people to take advantage of it. So they have to, if a hole breaks in a dam, you got to plug it, and that's 10 pages. And another hole breaks, you got to plug that, and that's another 10 pages. Before you know it, they just keep plugging these holes and creating more complexity. I think I've mentioned this before in our podcast, but United States, we do have a complicated tax system, but we also have, compared to any other developed country, the highest tax compliance rate than any other country. And there's reasons behind that. One is because our tax code is so complicated that there's a higher reliance on professional preparers than other countries. There's a better enforcement here. There's just Americans have a bigger sense.
I think people really enjoy the enforcement part. That's why they are so compliant. But I do like this interesting fact, which is people go after straws. We don't want plastic straws anymore. Yet the IRS sends out an average of 8 billion pieces of paper every tax season. So maybe we could start there instead with reducing use of paper. Yeah,
that's something that's kind of a common, there's certain times when you get tax notices or you want to send in a power of attorney, they only can do it through paper, or through fax, or through other means. And it's been kind of a big push with tax preparer associations to try to get into a more paperless. Think of what it was before you were allowed to e-file. Think about the paper costs. As early back as the early 2000s, and everybody had to mail in their tax returns, and e-filing was not a normal.
When did that change happen?
I honestly don't know, but it was probably late 90s, early 2000s. Huh. And it used to be to where my career, my generation, I've had the benefit of growing up when, we didn't have video games, and then we do. My career, I had the benefit of kind of getting into it when e-filing was sort of not the norm. I started my career in 2002. And for the most part, we still paper filed most of the returns then. And we would give paper copies to the clients and everything. And it slowly transitioned to where we were e-filing. And now the IRS requires you to e-file certain returns. And if you don't, if you mail it in, you have to attach a statement stating why you didn't e-file it.
Well, and that was just the IRS. I'm sure accounting firms were printing out just as much paper. But I think you're pretty much electronic now, aren't you? You store all of your stuff in the cloud. And
yes, I'm 100% paperless. I still get paper from clients, but I scan it into my system.
So John Michael is green.
Trying to be.
So, okay, so let's get on to the topic at hand, which is, we're not going to call it, we'll call it obscure, creative tax strategies and opportunities. That's a tongue twister. Can you say that three times real fast?
We just didn't know what to call this. And hopefully by the time you guys listen to this episode, there'll be some kind of title that makes sense. But the purpose of this, though, is I just wanted to bring out 2 or 3 big things and maybe a handful of smaller things that some people just don't know about. And, or there's situations out there in this complex code that, is just people are ignorant to. I use that word ignorant a lot, and sometimes people take it as a negative connotation. It's not a negative term to say somebody's ignorant to something. It just means they don't know about it. So moving forward, I'm going to talk, the first thing, an example, we'll talk about 1202 stock. Mari, do you know what 1202 stock is?
I know what stock is.
Yeah, so stock obviously is ownership interest in a corporation. So 1202 stock, the nitty gritty of it is if you buy this stock and it's qualifying small business stock and you hold it for 5 years, when you sell it, you don't have to pay any tax at all on that gain.
So give me an example, like what kind of company has that kind of stock?
Yeah, so if it was that easy, everybody would be buying this qualified small business stock. But so the first thing is that if you're buying it, the purpose of it is to incentivize investors to invest in small corporations. Now, one of the things is that the target company has to be a C corporation. I don't want to get into, C corps and S corps, but it has to be a C corp. So a lot of you'll see a lot of tax advice out there. They run away from C corps. Well, if you're aware of this 1202 stock, maybe it'll make you run to a C corp. Because if you invest into a C corp and it's qualifying, and you hang on to the stock for 5 years and sell it, you're not paying any tax on that at all. And that's called 1202 stock. It does have to be a C corporation. It has to be small, and small by their standards is that it can't have over $50 million in assets. So most small town corporations qualify for that. And that's just when the date the stock was issued. If you buy it and it qualifies, and in 10 years it grows to $1 billion company, then you still have that qualifying small business stock. It cannot be like a personal service type corporation, so it can't be a healthcare firm or a law firm or engineering, accounting, architecture, financial or brokerage services, anything that's sort of personal service. It cannot be a restaurant.
Well, okay, so what can it be? So far, it can't be anything. What can it be?
Well, it could be manufacturing, wholesale, breweries.
Oh.
Qualify for this. So, I'm not giving anything away. I'm not telling you should do or not do anything, but I like to do breweries sometimes and do this 1202 if it qualifies. You have to have 80% of the corporation's assets, of the value of the assets, must be used in active conduct of the business. So you can't just be a company that has $1 million of cash. You have to have assets. So like a qualify. A brewery may qualify because you're using 80% of your assets for active conduct in the business, all the brewing equipment and stuff. So if you do this and it qualifies, you buy stock in this corporation, you invest, you hang on to it for 5 years. You can exclude up to $10 million of gain. So if you buy it, say you buy a brewery, everything qualifies. You buy the stock for $10,000 and it just goes gangbusters over the next 10 years, and that stock is now worth $10 million and you sell it. you potentially will have zero gain on that $10 million. So that's a pretty good investment.
That is a pretty good investment.
Yeah. So 1202 stock is something that when we bring up C Corps, a lot of people don't even think about considering or know about. And if you're thinking about investing in a corporation and it is a stock investment in a C Corp, you should definitely inquire, does this qualify for 1202 stock? And if you do that, it does qualify if you get a document from the company that you're buying stock in saying, just verifying the date it was purchased, the amount you paid, a copy of the share certificate, and they certify that they are a domestic corporation, that they have less than $50 million of assets, and that 80% of the assets they use are in the course of business, and you hold it for 5 years, you've got 1202 stock. That's the key. You got to hold it for 5 years. If you sell it in 3, then you have gains. So that's something that I'll mention sometimes when we talk about C Corps, and there's just a lot of deer in headlights, we'll call it.
I actually like it, though. It's relevant. We have a lot of breweries here.
Yeah, and I'm not
a lot
saying
of them have under $50 million in assets, so it's kind of like a small brewery, I would think, a craft or something like that would qualify.
Yeah, so that's 1202. It's interesting. So something else we can maybe bring up is what I'll refer to as the 338H10 election.
And from your notes, it says buying stock legally. Is that what it says?
I think.
Because I hope we wouldn't be buying stock illegally.
Yeah, I don't think it says that. I think, so what I meant by that is that this is all about when you're buying a company. So when you buy something, people want to buy the stock for legal purposes. Because if you buy the stock of a company, it's like you hand over the keys. You don't dissolve that company, nothing like that. You hand over the keys. So all the current license, if it's a company with a bunch of licenses or agreements or contracts, say it's a big company and you don't want to necessarily transfer 50 contracts over. If you buy the stock, you just kind of hand over the keys.
Are you talking about you're 100% buying the company? This isn't like a partial buy of stock?
Yes, if you are buying a company.
Okay.
And for legal purposes, you don't want to redo anything. You just want to get the, just turn over the keys and then open the doors on Monday and not skip a step. You want to buy the stock because that just gives you the ownership. But for tax purposes, you don't want to buy the stock. You want to buy the assets. And do you know why that is? No. So, poor Mari.
Quizzing me over here.
No, I'm involving you in the conversation. So I told you why legally you'd want to buy it. So and I'm not an attorney, so I'm not giving legal advice, but and I'm referring to it as legally, but you're just transferring over the keys, everything stays the same, contracts and everything. Tax wise, if you buy stock and you get stock, you say you're buying a company for $10 million. Mm-hmm. And all you do is buy the stock. Well, you have stock with a basis of $10 million. You can't depreciate stock. If you buy Target stock online, great, you got $10 million worth of stock. But you don't have any tax benefit for that $10 million you just spent other than a high basis in that stock, right?
Okay.
Which means if you sold it tomorrow for $10 million, then you're going to have zero gain or loss because your basis is $10 million. But if you buy a company for $10 million and you buy the stock and you just shoved out the door $10 million, you're not getting any tax write-off for that by buying the stock. However, if you buy assets, say you buy the equipment, the building, the furniture and the fixtures, you buy all those assets for $10 million, you then can depreciate those assets over the future and get a tax write-off of those assets for depreciation.
Even if those assets have already been depreciated?
Well, you just bought them. They're brand new to you. It's like buying a used car. You don't pick up the person that sold it to you's basis. You're buying it brand new.
I'm kind of disagreeing with that analogy of the car, but maybe I shouldn't disagree with you on a podcast. Because when you buy a car, a used car, that doesn't mean that the value of that car that was already depreciated, like you're starting over again.
Well, okay, let's use the car for example. Say I owned a car for 5 years, Toyota Prius. I bought it for $20,000, and over 5 years, on my balance sheet, I'm a business, I depreciated it down to zero. So it's worth on my balance sheet zero because I got a $20,000 write-off through depreciation over the last 5 years. And then I turn around and sell it to you.
For 10.
For 10. Now that car is worth 10 to you. And now
I get to depreciate
and
the
you
10.
you get to depreciate $10,000 that you just gave me.
Okay.
So the same theory with asset sales, if I'm buying a building and equipment from a big manufacturing company, even though who cares what they did with it and how they depreciated it, I just bought it for $10 million. That's my basis in that equipment. And I get to depreciate $10 million.
Even if the equipment isn't worth that?
Well, it is worth it because I just paid $10 million for that.
But what if it wasn't really worth that?
Then I wouldn't buy that company for $10 million.
People do that all the time.
Well,
they overpay.
Well, so yes, to answer your question is then you got goodwill. And thank you for asking that. So say if it's $10 million, the equipment's only worth $1 million.
Well, I'm glad I got something out of this.
The difference, if you're like, well, the company's still worth $10 million, the difference between the $1 million and the $10 million is what we call goodwill.
Okay.
And that's kind of a inflated thing. And goodwill, you can amortize over 15 years and write that off. So if I'm about to, pass $10 million across the table, I want to get a tax write-off for that. If I buy stock, I'm not depreciating stock. I'm not getting a tax deduction out of that. So what happens is you can do what they call this 338H10 election, which basically allows you to do legal stock sell, but a tax asset sell. And I came in, I've got situations where I've come into companies wanting me to do a valuation to figure out their goodwill. And I'm starting this process and I'm realizing it was a stock sell. Well, as I said, there's no goodwill on stock. And I had to go to them and say, there's no goodwill here because you guys did a stock purchase. You have to make this election. In that situation, that's a long story. I don't want to go down that line, but you got to do certain things in order to do that. And the other hoops is to do this election, the company you're buying has to be an S Corp. If it's a C Corp, it doesn't qualify. You're going to have a double taxation situation. So this example, I had a company wanting me to value goodwill, and they were buying a C Corp, and they bought the stock. And I had to be the guy that was the bad guy that said, well, there's no goodwill here for you to depreciate. I'm sorry. And that's because they went into it and they did a stock sell and they should have done an asset sell at that point.
So circle back for a minute. What you're saying is if you're going to buy a company, it's better to not just buy the stock, but buy the assets because the assets are what you can depreciate over time. But there are certain qualifications on top of that, so don't just go buying assets, making sure it qualifies.
Yeah, so anytime I'm talking to somebody and they're buying or selling, if I'm representing the buyer, I'm like, you want it to be, if the target corporation is an S Corp, because of this 338H10 election, you can kind of have your cake and eat it too. You can have the seller can have a stock sell and the buyer can have an asset sell. If the target corporation is a C Corp, I tell my buyer, hey, go in and buy the assets. You're not from the corporation. The seller is going to say, no, I want to sell my stock. Because if you're selling stock, it's just a capital gain if you're a C corporation. The problem is if you're a C corporation and you own these assets in the C corporation and somebody comes in and buys $10 million of your assets, the $10 million goes to the C corporation. And now that C corporation has no assets, and now it's got to get to the owners. So you're getting a double taxation scenario. So you've got to be careful all the way from the beginning that if you know you're going to sell this company, you got to think about if you're going to be a C corporation or an S corporation, because it can matter exponentially when you come to selling. If you're a C corporation, great. If they don't want to do a stock sell and do that 1202 and the buyers come in and want to do an asset sell because they want to depreciate it, you've got to set up something that keeps something out of the C Corp that they can buy, or you got to do an S Corp. So there's things to know from the beginning and talk to somebody like me that kind of is aware of a lot of this stuff from the beginning, or if not, how to like what you need to do or call it. I get people all the time coming to me in the middle of it, and I'm like, well, we need to do X, Y, and Z to defend against or to set up, I guess, a situation where you can offer an asset sale or the stock sale, whatever is beneficial. And a lot of times I'll say, if whoever I'm representing, don't bring this up unless they bring it up, because this is the best situation from your perspective. If they don't counter, then go with it.
So this advice pertains to if you are buying or selling a company, seek advice.
Yeah. And the cool thing is this 338H10 election allows you to have your cake and eat it too if the selling company is an S corp.
All right.
It's a pretty cool thing to be aware of, and I've had some intricate deals that I've been involved in that has involved some of those. But yeah, if you're buying, you want to buy assets. If you're selling, you want to sell stock. And obviously, those things they don't jive sometimes.
Okay, so before we get to your next topic, let's take a brief break.
This podcast is brought to you by Peridot Consulting and Marketing Outpost. Peridot Consulting offers a new paradigm in accounting services. We work with individuals and businesses toward prosperity and financial happiness. Please visit www.peridotconsultinginc.com for more information. Marketing Outpost provides strategies to solve problems and strategies to grow your business. Please visit www.marketingoutpost.com for more information.
Okay, so we're back. What's next?
Just some other things that may be more common, people may have heard of, but I can talk about the nuances of them. Like, I'm sure you've heard of this, Maury, a 1031 exchange.
Why do you say that?
Well, it's just because it's a common thing.
I have.
Yeah, why are you defensive over that?
Because I didn't know. I wasn't being defensive. You were just like, I'm sure you've heard of this.
Well, it's something that people have heard of. It's a 1031.
It is.
Yeah.
I'm just doing my usual, giving you a hard time.
Yeah, it's easy to do.
Okay, so tell me about 1031s.
Well, basically, a 1031 is if you've got an investment property, a rental, but the easiest examples are rental property. So you got a investment property, a rental property, and you say another investment opportunity comes up, and you really want to like just get rid of this rental property and get into this new one because it's a better house that's your neighborhood or something, and you want to do it. So a 1031 happens is you can sell that one investment property and buy another investment property and not have any gain on the property that you sold if you take that money and use that to buy this new property. So it's a way of not paying taxes on a gain of a sale of an investment property. Now, obviously the nuances and the details matter with a 1031 exchange. Is a like-kind exchange. It has to be something similar. You can't sell a rental house and buy stock, Amazon stock. That's not similar properties. You can sell that property. You can buy up to 3 properties that are like divided amongst that, or you can up to 200% of the value of the property sold. You can buy unlimited properties, and they can be the rules are pretty lax in what is like. You can sell a commercial building and buy a residential building, things like that, or they're smoother. But the biggest steps and hurdles you got to jump through is some people will come to me and say, "Hey, I sold my rental house. I'm thinking about doing a 1031." And probably at that point, you've already blown the election. If you sell a house and if the money hits your personal account, you blew the election. If you sell a house and 6 months later you decide to buy another, you probably blew the election. To do a 1031, you got to know you're going to do it from the beginning. You got to say, okay, I'm going to sell this house. You have to identify a new property within 45 days of selling that house. You have to get what they call a qualified intermediary. Sometimes your real estate attorney will do this, to where when you sell your rental investment, they hold the money. If it hits your personal account, you blow the election. They hold the money in an escrow account, not you. A qualified intermediary holds it. You go out, and within 45 days, you got to identify a property, and within 180 days, you've got to close on that property. And if you do that, and you close on the property, the qualified intermediary will give the money straight to the person you're buying. And you got a 1031 exchange, and you basically didn't have any gain on that. Now, that's nice, but there's things you got to consider, the fact that, you're paying commissions, legal fees, tax advisor fees, financing. So sometimes a 1031 is all fine and dandy, but it's not really worth it after you factor in those fees. The qualified intermediary fees. Also, another thing a 1031 does is it's really just kicking the can down the road, is all it does. And what I mean by that is, you have a rental house, you bought it for $100,000, you sell it for $200,000. You go out and buy another rental house for $200,000. You're thinking, okay, this new rental house is worth $200,000. No, it's on your books at $100,000 because you carry that basis over from the first house. You just keep carrying that basis. So eventually, when you sell that third house for $300,000, you're going to have a $200,000 gain, even though you bought it for $200,000, because you carry that basis over. So yes, it defers that tax, but it kicks it down the road. Eventually, you're going to get the full gain back to your original basis of the original 1031. You can do, 1031, 1031, 1031, and build a $100,000 house into $1 million house, but you're going to have a big gain when you finally cash it in and decide to take that gain. So I'm just going to move on to some just other quick things that people may or may not be aware of. I get this question a lot. They're selling their primary house. How much gain do they have? There's this rule called the 2 of the last 5 year rule. Basically, if you live in your primary house for 2 of the last 5 years, we can get into some of those details in a minute. Then if you sell it and you're single, your gain, which is the difference between your purchase price when you got it and your sales price, if that gain is under $250,000, there's no tax implications. If you're married, $500,000. It's the 2 of the last 5 year rule. So you can sell your primary house for the most part, unless you make a lot of money on it, and not have any tax implications. So 2 of the last 5 years means you can live in it for 2 years. You can sit empty for 3 years and then sell it, before the end of that 3rd year, and you still qualify. Some people, they live in their house for 2 years. They decide they want to rent it out for a while. You can, but what happens is when you depreciate it over the 3 years, there's going to be some depreciation recapture, which is ordinary income tax on the amount that was depreciated. But if you still sell it within 2 of the last 5 years, then you still qualify for that.
What if you've lived in it for 20 years and you bought it very low?
Yeah, I mean, if you lived in it for 20 years, then obviously you've lived in it for 2 of the last 5 years. And if you bought it, in 1980 for $100,000 and you sell it now for $5 million, then you're going to have a gain because you made more than the gain exclusion, but you still get excluded. $250,000 of it for single gets excluded, and $500,000 if you're married gets excluded. So yes, there will be a gain on examples like that if you make that much money. But most people, the gains fall within that range and they don't have it. Sometimes you don't even have to put it on your tax return, even if you made $200,000. Now, I always try to just to cover all the bases. Some states require that you get what they call a 1099-S, I believe is what it is a statement saying you got $250,000 for the sale of your home. Some don't. So if you get a 1099-S, that means the IRS got it. You might as well put it on your tax return, show the exclusion, to answer any questions that they may or may not ask. Other things people may not know about, I'll get into some medical expenses. If you do an improvement to your home, say you had to put in a wheelchair ramp or an elevator or something for medical purposes, that can qualify as a medical expense and be deducted the way where your other medical expenses are. If you get service dogs, some schools, we've got a school in town that's a key school. It's for dyslexia, and doctors will prescribe for children to go there. That can be a tax deduction. So there's things to be aware of that could, for medical, for medical. I'm talking under the medical umbrella here, that if you're doing things for medical purposes, they may be a medical expense deduction that you may or may not be able to take advantage of.
Is that different from like a home improvement deduction type of thing?
Yeah, I mean, if you just have your house and you just decide to, I don't know, remodel your kitchen, the only thing that does is increase the basis of your house. So if you sell it, your basis is higher, so that gain exclusion that we talked about previously.
Well, a big thing now is that a lot of people are modifying their homes for senior living. So, like if you did put in ramps or you put in one of those stair things that goes up and
The
down.
elevator.
Yeah. Does that, or what are those big things that they're always doing on the commercials, the bathtubs?
Yeah.
Safe, slip bathtubs. Is that part of this?
Probably. Now there's, the nuances. It's got to be for medical purposes, probably prescribed by a doctor.
I see. So that wouldn't be like, oh, I'm just doing this for my senior living health.
Yeah, I'm putting this elevator in because I'm just too tired of walking up and down the stairs.
Well, maybe my knees and joints hurt, so I would have to have my
if your
doctor said that for arthritis.
If your doctor prescribes saying, look, you need to stop walking up and down the stairs, it's killing your knees, and because of that you're getting this elevator, then yes. So there is that nuance of a difference. Talk a little bit about retirement accounts. There's what we call SEPs, S-E-P. It's a self-employment pension. If you're self-employed, you can contribute up to 25% of your earned income, max $55,000, into these SEPs, and it's a deduction against your business income. If you do a traditional IRA, you can do $5,500 or $6,500 if you're 50 and over into a traditional IRA, and it's a deduction. A Roth, if you do a Roth IRA, it is not a deduction when you contribute. However, when you take it out when you retire, it is not income. Traditional and SEPs, when you take it out and retire, it's ordinary income because you deducted it when you put it in. It's income when you take it out. A Roth, you do not deduct when you put it in, so it's not income when you take it out. So you get that tax-free growth. There's some credits people may or may not be aware of. There's the earned income credit. That's a big refundable credit if you qualify. There's education credits. There's the American Opportunity Tax Credit. If you're making $80,000 single or under $160,000 married filing joint, this is for college tuition. You can get up to $2,500 of that college tuition as a credit back to you against your taxes. Now, there's a difference between credits and deductions. Deduction reduces the income that's taxed. A credit goes directly against your tax. So a credit is much stronger than a deduction. And then the other education credit is the lifetime learning credit, which you can get for postgraduate and the first four. The American Opportunity is just for the first four, and it can be up to $2,000 per student credit. There's dependent care credits that you can get. It can be 35% of qualifying expenses with AGI limits. So if you pay for daycare, something like that, you can get a credit for that.
Are there any kind of credits or deductions or benefits that of this nature that are obscure for pets? Because everybody's got a friggin' pet.
The only thing would be if that pet was like a service dog, or for medical purposes, or a service cat, or service goldfish.
Okay.
I've seen pets in other situations where if you foster animals for a charity, to where it could potentially be a charitable.
What about people that donate or not donate, but they will their estate to a pet?
Oh, we've talked. This has come up in a podcast before. How do they do that?
How do they tax the pet?
They tax the estate, not the pet.
Because the pet's not paying taxes.
The pet's not a legal entity. Some people, I get this question a lot about electric vehicles. You can get up to a $7,500 credit on electric vehicles.
Didn't you just buy one?
Well, I got a hybrid.
Oh, that's not the same.
Yeah,
that's a gas, whatever.
Yeah. Teslas will qualify for this. So that's another sort of fun thing. And there's a ton. I can keep going. I mean, there's a ton of things. I kind of covered some complicated ones, 1202 stock, 338H. I covered some common ones like the 1031 or the 2 of the last 5 year rule. So my point is there's a lot of things. If you're buying and selling a business or doing anything, a lot of nuances. I've come across, very fantastic accountants and attorneys that weren't very aware of some of these. And my point is that even though you may have
there's 70,000 pages of tax code, so that's a lot to remember.
And there's plenty I'm not aware of. I'm not saying I'm better or worse than anybody else, because
I would say, though, that if you have anything to do with money changing hands other than you just buying and selling goods, or even that, you should consult a professional.
Yeah, you should, because you don't want to be in a situation. I always say too, if you're in a buying and selling situation and the other person's attorney is kind of handling everything, get your own attorney, because it could be a 338 situation that they're not, or something that you could take advantage of that they're not going to tell you about if it benefits their client. Some attorneys are good about this, saying, look, I'm not representing you, I'm representing the buyer, but you want to make sure you have your own representation that's looking out for your own interests, for sure.
Okay, so in this brief amount of time, you've covered what you could with obscure, creative tax strategies and opportunities, and I'm sure there are a myriad more of those kinds of things out there. But in a nutshell, if you are buying and selling anything or have a large transfer of money anywhere, personally or business-wise, you should probably consult a professional just to make sure you take advantage of all the obscure, creative tax strategies out there.
Or aware of, the negatives.
Exactly. So we want to thank you for joining us today, listeners, and please be sure to review this episode. For more information on who we are or this podcast, please visit www.bammit.com. That's BAMM-IT.com. And join us for our next episode, where we will be interviewing a new business owner about her experiences buying and a dental practice, I believe. And she's also a new business owner. So we're going to interview her from that perspective. Thank you.
Thank you.
The hosts and the guests of this podcast make no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice and is for entertainment purposes. It is not guaranteed that you will find this as entertaining as the hosts find themselves.